Hello, I have been trying to think of a way to professionally send over a video just explaining kind of the SVB position and just generally some of the effects of what's going on in the bond market, to our clients. And this is as professional as I could get, I'm afraid. I got stuck trying to film stuff, and so now I'm going to do another narrated overview. But I think it's really important to understand this because it will help hopefully give some understanding about where some of the banking issues are, what's happened with some cautious investments, what's happened with some bonds. So all I'm going to do is just explain what happens with a gilt or a treasury bond over its lifetime, because everything is being linked back to these at the moment. So if I call it a gilt, basically, what a gilt is, it's a loan to the government. And so let's say on day one, you loan the government £100. The question is, why would you do that? Because they'll give you, historically speaking, let's say £2 for every year that you lend it to them. And the most common gilt is a 10-year gilt, you can see over here. So what happens is you give the government £100, they give you £2 a year until 10 years' time when they give you that £100 back. And it's classed as almost like the risk-free return. It's one of the safest, in investment world speak. It's one of the safest assets you can have because the UK government, the US government has always paid its debts. So what happens once you do that? As soon as you issue that gilt, it doesn't just sit there. That £100 or that gilt, it gets traded on the markets. And in normal conditions, in normal times, this solid line here, it trades in a small band, so it's going up and down. It might be trading at £105 or it might be trading at £95, and it moves within this band based on interest rate movements and a range of other factors. But what's happened is we've now gone into abnormal times with regards to interest rate moves. So if we take, the last couple of years, the last 18 months, let's say, interest rates have been going up and up and up. And so what that means is this £2 that I've been getting, or this 2% that has been paid on my £100, is now not very attractive if I can get 4% elsewhere or 6% elsewhere. So what happens is people sell their bonds because they can get better returns elsewhere. And when you increase the supply, the value drops. So you can see now that the value has been dropping over the last 18 months. So let's say the last year, let's go back almost from November 21 to November 22, or even a bit earlier than that, before the mini budget in the UK, these were going down in value. Now, why were they going down in value? Because if you can buy one, someone will buy one for £80, let's say. Well, now I'm getting 2.5% on my money because I'm still getting my £2 that the government pays because that's fixed, but I'm only buying it for £80, which means I'm getting a 2.5% yield or return, and that's now more attractive. So that's what happened, and there was some support, but go back to the mini budget time, there was just a massive lack of confidence in the UK, and so our gilts rock bottom down here. And there's a story or a conversation that actually over here you could get a Oxford University bonds or a loan to Oxford University for £50, and that was still giving you £2 a year, which means you're getting 4%. So people would buy that. Now the other reason that they buy that is that what happens at the end of this term, let's say we've got 3 more years left, I'm getting £2 a year off £50 because I've just bought it down here. So I'm getting 4% a year from my 50, and I get £100 back in 3 years' time. So I've made 100% return on my money as well, because the government or Oxford University in this instance will pay me back. The worry is, what if they don't pay you back? And that's why government bonds, gilts or treasury bonds, are seen as really safe, because it's highly, highly unlikely the UK government or the US government won't pay you back. So this is the kind of scenario of what's going on. And actually here and in this space, it's quite can't go so far as say exciting, but it's an opportunistic time for bonds, and we've not had this opportunity for years and years because they've been trading at the top end of this normal line for a long time. But if we now look at the banking crisis, SVB, what's happened here is that SVB holds loads of these. They hold the Treasury style, so the US style of these. And why do they hold them? Because over the years, they've had, they work mostly in tech, and tech companies have raised lots of money, and they've deposited this money with SVB. And as soon as they deposit this money, SVB have to pay them a yield. They have to pay them 1% or 2% interest on the money that they leave with them. So for them to generate that 1 or 2%, they buy these treasuries because they're super safe and they go up and down like this, and therefore you can know that you're going to get you £2 a year, and you know that they'll pay you back at the end. So it's a nice simple way for them to make a little bit of money on the deposits that they hold. And they have to hold an amount of these to be able to show to their regulators that they're safe. The UK market has the same thing with our banks. Now, the difference or the thing in the US is that with SVB, they've, on their balance sheets, when they do their accounting, they value it at £100 because they know they bought it for £100 and they know they're going to get £100 back at the end of the term. They kind of ignore all of this noise on the in-between. But what's happened since they got all of this money in, let's say 2021, when tech companies were flying and were raising lots of money and depositing it, suddenly they want some of this money back because they're not doing so well, and they're not generating the returns they were, and they need it for cash flow. So they're asking SVB for the money back. But for them to give the money back, they have to sell this bond at this point in time. And this might be down here at, let's say, £75 when they bought it at 100, which is a loss. So it's okay to do that for a small amount, but suddenly people are starting to look under the bonnet and they're saying, hold on, they've got all of these investments priced at £100, but if everybody asks for their money and wants it back at 75 or 70, they won't have enough to pay everyone back. And therefore, the bank will be, it won't be solvent. It won't be able to pay its debts. So this is when you start to get a run on the bank, and everyone starts to say, right, I don't want to be the last person in there. Even though I know if we just leave it until here, we'll be okay. I'm going to take my money out and put it with a bigger bank, with somebody else that's more solvent. Now, the great thing the Federal Reserve, the equivalent of the Bank of England, did is they came in and they basically said, this difference here, we're going to match it. So don't worry, if you've got withdrawals that you need to make and you're going to have to sell these bonds, we'll make up this difference. And you think, well, is that a big loss for them? Not really, because they're going to have to pay it back at the end of this term anyway. All they're really doing is paying it back early and paying, and reducing these interest payments that they might have in the future. So it's a pretty good way for the Federal Reserve, for the Bank of England to be able to shore up the banks. So that's where we sit right now. Now, not everybody knows this. A lot of retail investors definitely will have been selling their bank stocks yesterday. There still will be uncertainty. And when you have, if you remember the rising interest rates over this period, when you have those for a period of time, there's a lag between those kicking in and then there being an effect on the markets in real life. And this is what we're starting to see now, is this effect in real life. But our view of the SVB crisis and, the current position of banks is that this mechanism that the Bank of England and the Federal Reserve have in place is a really solid way to shore up those balance sheets without causing much pain. And actually, the only real worry for the banks is if there is a panic situation. And hopefully the Bank of England, the Treasury or the Federal Reserve have good ways to shore this up. If we compare where we are to 2008, the value of these bonds that were securing the bank's balance sheet, they were at £0 because those were those awful collateralized mortgages, the ones, if you watch The Big Short, you were going around America and there were these dilapidated houses with nobody in, with pretty much zero value. That's what was showing up the banks before. Now, since the new regulations in, it's these gilt and treasury bonds that are secure. They will be paid back at the end of the term, so long as the UK government, the US government pays its debts. And so it's a completely different scenario security-wise. That being said, we've just got to see how people react and what goes on. But this hopefully gives a bit of insight as to what's going on, one, in the bond market, but two, in terms of opportunities that Beckett's are maximising now, and three, in terms of the banking situation in the US and potentially in the UK. I hope this has been helpful for anyone. As ever, we're available for questions whenever you want to go through anything with us. Thank you so much for listening, and speak to you soon.